Brent Freeman with the CBB Group. In this episode, we're going to talk about business valuations and more specifically the three types that are available in the marketplace, why you'd use one versus the other, and the costs associated with each one. So if you're a business buyer, a seller, or an owner that's thinking about a valuation, stick around because at a 50,000 foot level, we'll go through all three and why you'd want one versus the other. As always, if you've got questions as we go through this episode, please feel free to put them in the comment section below or simply pop me an email and I'll get back to you as soon as I can. In addition, if you find this episode interesting or you get something out of it, please feel free to hit that like and subscribe button. And with that, let's talk about business valuations. Now, there are four basic purposes for when ordering a business valuation, and they are tax, litigation, transactions, and regulatory. To further segment these four categories, let's put them in two groups. Tax valuations, which would include estate tax, gift tax, ESOPs, allocation of lump sum purchase price, charitable contributions, and calculation of built-in gains for an S corporation. The second group that you'd put together would be around non-tax valuations. And they'd include purchases, sales, mergers, buy-sell agreements, regulatory valuations, and then litigation support, which include partner or shareholder disputes, divorce actions, or damage and economic loss calculations. Before we get to the three valuation types, I think it's really important to understand two basic concepts of valuation. The first is the standard of value, and the second is the premise of value. So the standard of value really defines in three basic ways. There's fair market value, basically what a buyer and a seller would pay in the open marketplace. Fair value, which is determined by state regs, and it's really used when you're looking at shareholder disputes or shareholder rights. And then the last one is strategic investment value. Now, let's go down to the premise of value. There are really four basic premises of value: book value, going concern, liquidation value, and replacement value. Now, going concern value is the one that when I'm called to do a valuation is most often used. And really, that's the value of the business that is expected to continue to operate in the future. So you've got a business, it's running, you're not closing it down, you're going to keep running it. And what's the value of that business? Book value is simply the difference between a company's assets minus its liabilities, adjusting for depreciation and amortization. And really, it's just a quick way to judge the asset level of a company or the liquidity. Liquidation value, so you've decided to close the business or you're considering it, and you want to know what the value of the assets are if you sold them in either a forced or orderly fashion. And then lastly, a replacement value, which is really just marking to market the assets of the company to their current value and valuing it that way. So again, the standard of value is really important, and then the premise of value. In summary, we usually see fair market value and a going concern. Obviously, fair market value being just the value in the open marketplace, and the going concern being the company is going to continue to operate. So, value, standards, and premise. The highest level of valuation is a conclusion of value. And that was really defined by Revenue Ruling 5960 and some other IRS and revenue rulings that have since come. But basically, it talks about that fair market value that we covered earlier, as well as additional items. And they can be history and nature of the business, economic outlook of the U.S. and the specific industry, book value of the company and a financial status of the company, earnings capacity, dividend paying capacity, whether the business has goodwill or other intangible values that are to be included, prior sales of stock, and the size of which those stock sales were done. So if there were 20% or 30%, and then the market price of equity interest that may be traded in the open market. So you can see that a valuator has to go through quite a investigational aspect in putting this valuation together. For me, that starts with an initial data request and then an actual sit-down interview of the owner or the principals of the company and understanding in a pretty deep analysis their business. This report, when finally issued, is usually anywhere from 80 to maybe 110 pages long. And again, for it to be a conclusion of value, there's a lot of other things that go on, but this is the original definition and what has to take place to drive a conclusion of value. Now, let's talk about when you'd use a conclusion of value. Conclusion of value, when would you use it? You could use it on any of the above, but when do you have to use it? Well, you've got to use it when you're doing anything related to tax, litigation, regulatory, and or litigation that involves damage or economic loss calculations. So that's when you would use it. Now, the cost of a conclusion of value starts at around $8,000 to $10,000 and goes up. And you can imagine if you're in litigation or you're trying to do regulatory compliance on a corporation that may have 200 or 300 million in revenue, it can be a pretty expensive item, as well as you need a well-trained and certified valuator that's experienced in that area. But again, when would you use it? You could use it on any time you're looking at a valuation, cost 8 to 10, and goes up from there. The second valuation type is what's called a calculated value or calculation of value. And that's where a valuator and the principal or party ordering the valuation agree on the method or methodologies that'll be applied in just a straight calculation and then reaching a value. So the difference between a calculation or a calculated value and a conclusion of value is there's a lot less research. So the valuator in a calculated value is not going to be considering global or US or local economic criteria. They're not going to be looking at the industry. They're not going to be doing a tremendously deep dive into the corporation, understanding product lines and things of that nature. They're basically going to take the financials, do a recast, and then apply 2 or 3 or whatever they agree on valuation methodologies, and at the end of that they'll come to a calculation of value. So that report, the way that I do it, is probably around 20 to 35 pages, and I'll probably do 3 or 4 different valuation methodologies to figure out the final calculation of value. But the difference between is just a really deep dive and the valuation. Now, when would you use them and what's the cost? Well, you'd use them on any non-tax valuation request. So a purchase, sale, merger, those could all be done in with a calculation of value. The other things that you could take a look at is shareholder dispute, as long as both parties understand. But you've got to be careful in anything that requires or is probably going to involve court or litigation. You want a conclusion of value. As a matter of practice, I won't put a calculation of value together if I know there's a good chance, especially in a shareholder dispute, where they're going to be going to court, because usually the other party orders a conclusion of value. So when would you use it? Non-tax. It's a lot simpler and the cost is a lot reduced. So in our marketplace, we're charging anywhere from between $2,500 to $4,500 for a calculation of value. And that just depends on the size, the complexity of the firm, and the number of different methods that are being used to do the calculation. This last valuation is a market range valuation, and I've got to point out that this valuation is a non-certified valuation and does not meet the standards of a National Association of Certified Valuators and Analysts, which the calculation of value and the conclusion of value do. Now, when would you use this? We usually use this with small businesses with revenue of less than $3 million, and you're looking at an SDE or a small EBITDA. But usually we're using this when just talking about an exit plan and maybe what their net equity would be in a potential deal structure. Now, the cost for this valuation is between $1,000 and $1,200, and really, again, it's a very small valuation, usually 10 to 12 pages long, and we'll probably run just two basic valuation methodologies to understand the value in the open marketplace. There you have it. 3 types of valuations: a conclusion of value, calculation of value, and a market range value, when you would use them, what their basics are, and what the costs are. So if you're an owner or a buyer and you're looking to order a valuation, understanding why you need it and what you're trying to accomplish will help you in selecting and ordering the right valuation. Make sure you have a good conversation with your valuator and that they fully understand what you're trying to accomplish. So if you got something out of this episode, please hit the like and subscribe button. And with that, I'll see you on the next episode.